It's great to be back at O&M Partners again to speak with you today. Today, we're going to be talking about the royalty streamer model and why your portfolio needs at least one of them. Little disclaimer here that we always present at the beginning. Explorers help restock the resource and reserve pipelines of the majors. Producers deliver the goods to the market, and a royalty company provides funding to build a mill, expand the mine, harvest the ore, or discover new greenfield deposits. Bill Sheriff, Executive Chairman of Golden Predator, made this comment on one of an earlier O&M presentations, and I think he's right on the money. And he asked the question, why are royalties outperforming almost every other type of mining concept right now? It's because they generate revenue for themselves as opposed to spending other people's money by drilling and financing again and drilling some more and eventually having a very bloated share structure. And he's right that this model really is, if it's not broken, it's very close to. And companies that do this, as opposed to generating revenue while they're looking for something, really are not going to be doing much service to shareholders going forward, even as this bull market moves forward rapidly, which it's doing as we speak. The definition of a royalty and a streamer are a bit different, but today we're going to use the terms interchangeably. The difference has to do with how they acquire the financing and how they receive on their part of the bargain, which is slightly different, but they are complementary to each other. And indeed, royalty companies can use streamer model and vice versa. The central difference is that both of them hold a number of different types of resource sector items. The most common and popular are gold and silver and copper. But you also have royalties that deal in base metals and even coal or uranium. And probably the first company to come up with the royalty concept was Franco-Nevada, and they have been massively successful. And what's interesting about this concept, and I'd like to have people consider this throughout the talk, is that the royalty concept is extremely versatile, and it is having constant new iterations being put in all the time by the participants. A real structured royalty company has a mix of current or near-term production and occasionally some exploration properties that might be brownfield, which would be on a known property area where production is already taking place, or greenfield, where we're looking for something that we don't know it's even there yet. So quite a mix that you can have in a well-structured royalty company. The basic difference then I want to mention about a royalty structure is that they finance a program with upfront payments, and they get a percent of the sales of the revenue versus the actual gold from the hoped for production. And this can be for a certain number of years, or it can be life of mine, which in the trade we call LOM. So keep in mind that the royalty is the right to a percentage of the proceeds from the miner's sale of the metal going forward. The streamer model is a little bit different. They can also help finance a mine or mill construction, and in return, they receive a stream, which is a specific number of physical gold or silver ounces per year at an agreed upon price. The most well-known of the streamers, and one of the earliest ones really, was Silver Wheaton, which is now called Wheaton Precious Metals, and they stream a number of different companies using this concept, where they buy the future gold production at a steep discount to the current spot price in order to pay money for the mining operation. And then when they get that metal, they sell it in the open market at whatever rate the prevailing rate is. And when the market is rising, like we're seeing currently now, where silver and gold are attempting to break out into new nominal highs for this move, they can make extra money beyond what they anticipated. And so a rising market can really fatten the coffers of a royalty company when they have a streaming model like this. We want to look at the advantages that having a royalty in your portfolio provides to the investor. There are a number of them. If you just hold a mining company, there are all sorts of things that can go wrong. A mine shaft can collapse. You can have run out of ore. There was a silver company recently that has going to sell a project because they have no more ore in that one. You can have country risk, any number of things can happen. The grades can drop. But if you have a royalty company, they have a series of companies that are have a contract to pay them a certain amount or give them a certain amount of metal. And it doesn't matter to them what happens to the mining company, they still get by contract what they've been promised. And so the investor is shielded, and so is the royalty company, from many of the risks that would accrue from simply having a mining company or an exploration company. They have diversification. There's not just one or two mining companies in a royalty. They can be 10 or 15 or more. And so that spreads out the risk. You have risk mitigation in terms of social or political or operational surprises. Mining royalties have much lower overhead, and they have a surprisingly small workforce with a high dollar performance per employee. And they can plow that money back because they're making income into buying additional royalties for the portfolio, or they can even sell a royalty. Sometime down the line, you might even find that the royalty company starts paying dividends. But the key thing is that they're bringing in money now, not at some imagined time in the future of 1, 2, 3, 4 years ahead. Royalty streaming operational cautionaries. There's always some risk involved. You have to be careful and balance out political risk versus the blue sky anticipation. You can have post-contract signing issues where there's a geologic operational risk. If you have a market downturn, which we went through several years ago and kind of coming out of that now, you can have a cash flow problem with the miner. It's really important that the miner under contract and the streamer itself does due diligence. They need to make sure they're getting what they think they're going to get and that it actually works out as they plan. The Morgan report likes certain iterations of the royalty model. For one thing, it avoids what I call the ETF listing curse, where you have companies that are in an ETF, and if the company does really well, it becomes too large for the ETF in terms of a percentage overall basis. And so they'll sell a bunch of their shares in order to bring it back into alignment, which you can imagine hurts the shareholder who has that company, which suddenly now doesn't have much high price as it did before. Whereas a royalty doesn't have that kind of an issue because they basically have their own ETF, so to speak. You have backyard country risk mitigation. If you have a royalty company that primarily invests in what I would call politically safe, low country risk areas, especially US, Canada, Australia, and Europe are the most pronounced ones. They don't all have to be there, but your core positions ideally should be there to kind of keep things stable for you and the shareholder. Also, in these areas, the geology tends to be better understood, and the rule of law is paramount. And those are very, very important in terms of you getting not only a return on your money, but a return of your money. So ideally, the perfect streamer royalty model is scalable and sustainable. It can start at very, very tiny, and it can go up, and it should be able to scale up to from pennies share type thing with well under $1 to many, many dollars if the model is set up properly, sometimes beyond what you could imagine. And I would suggest that investors look at the agreement structure that a royalty company has on their website before you invest and make sure that you know what you're getting. And they'll give you a good idea, in addition to talking to IR, as to what they're all about and their plans that they have in mind. The timing is just right for the royalty company and for people who invest in them, because as this chart shows, the relationship between gold and the shares themselves, the mining shares, is really out of whack and has been for many years. But there are indications that mining shares are going to begin outperforming the metal, as they should, of gold and silver going forward. And this will really go to the bottom line for the royalty companies and for the shareholders of those companies as we get that kind of outperformance, which by definition they should be doing because of a little bit of extra risk over the metal itself. And I think this is going to become the theme of the next few years, which is just one more big tailwind for the royalty concept and the shareholders who participate in them. David Morgan has a monthly letter. I've been an analyst at the Morgan Report for about 15 years. I really believe in this company that he has, and we have more mining companies that have gone on from explorer status to mining, actually becoming a mining company than anybody else in the business. and we will really treat you well. I really enjoy our shareholder base, and I think you will too if you would like to take a look at his value proposition. And I'd like to thank O&M Partners for giving me this opportunity to speak today. And I wish everyone here the very, very best as we go forward on this very, very exciting bull run that should run for at least the next 3 to 5, perhaps 10 years.